Hey traders, for today's trade we're looking at an option strategy known as a cash secured put in Dow Jones stock Cisco. This is a great strategy to use if you are looking to buy the stock or any stock or any ETF at a price below the current one. Or it can also give you a nice boost to the yield. So looking at Cisco on MarketSmith, shares surged roughly 3.5% last week as the stock took out a 51.84 buy point in decent volume. The 5-week flat base began forming back in late February and formed next to a prior 9-week flat base that failed to support a breakout. These neighboring bases mean that the stock has been trading sideways since the start of this year, but have maintained support at their 200-day line. In February, the stock retook support at its 50-day line and has been coasting above this level since then. Most importantly, the stock maintains a yield of roughly 3% at this time. Investors wanting to take ownership of Cisco can potentially do so at a reduced price with a strategy known as a cash secured put. This option trade is slightly less bullish than buying the stock outright and involves selling an at-the-money or out-of-the-money put while simultaneously setting aside enough cash to buy the stock. The goal is either to have the put expire worthless and keep the premium, or be assigned and acquire the stock below the current price. Selling put options is an easy place for investors to start with options. They are kind of like a covered call and pretty easy to understand once you know the basics. So let's take a look at my trading platform and set up this trade using Cisco.
So with Cisco trading around $52 a share, investors can consider selling a June 16th expiring put with a 50 strike.
With Cisco trading around $52 a share, investors can consider selling a June expiring put with the strike price of $50 for around $1.30. An investor selling this put would receive $130 into their account, which would be theirs to keep. If Cisco falls below $50 by June 16th, you would be required to buy 100 shares at $50 a share. The net effective cost of the position would be $48.70 thanks to the option premium received. That's 6.85% below Friday's closing price. If the stock stays above 50 at expiration, the put expires worthless, leaving the trader with a roughly 2.67% return on capital at risk. That works out to be 13% annualized. The main risk with this trade is similar to outright stock ownership. If the stock falls quickly, the trade will suffer a loss. However, the premium received will help to offset that loss. The maximum loss in the trade would occur in the highly unlikely case that Cisco fell to $0 a share, which would see the trade lose $4,870, but most traders would cut their losses long before then. As always, remember that if you're new to options, make sure you practice with a virtual account before risking any real money, and remember that options are complex and investors can lose 100% or more of their investment in some cases. Check out the new Options Trader app from IBD for digestible options education and great trade ideas. And be sure to join us here for our regular options content where we break down a new trade idea every day.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.